Right now, as you're watching this video, central banks worldwide are executing one of the largest coordinated gold acquisitions in modern history. And here's what makes this truly unprecedented. They're doing it despite gold trading at all-time highs above $5,000 per ounce. Let me give you the numbers that should make you sit up and pay attention. Central banks are currently purchasing an average of 60 tons of gold every single month. To put that in perspective, before 2022, monthly purchases averaged just 17 tons. We're talking about a threefold increase in institutional buying that has sustained for over 4 years. Poland has emerged as the most aggressive buyer, accumulating 95 tons through November 2025 alone. Kazakhstan follows with 49 tons. But here's the kicker. These are just the disclosed purchases. Many analysts believe actual global central bank gold acquisition is significantly higher, as some nations prefer to buy quietly to avoid telegraphing their strategy. And the most telling data point? According to the World Gold Council's latest survey, 95% of central banks, that's essentially all of them, expect to increase their gold reserves over the next 12 months. When was the last time you saw 95% consensus on anything among central bankers? This isn't a temporary spike. This is a structural shift. The message is crystal clear. While retail investors worry about buying at the top, the world's smartest money managers are treating $5,000 gold as a bargain for strategic accumulation. To understand why this matters, we need to look at history. For decades following World War II, the global monetary system operated under what's called the dollar standard. The US dollar dominated international reserves, global trade was denominated in dollars, and central banks held the majority of their assets in US Treasury securities. The pre-2022 normal saw central banks purchasing 400 to 500 tons of gold annually. Steady, but unremarkable. Then something changed. Actually, several things changed simultaneously. First, we saw unprecedented fiscal expansion in developed nations, with the U.S. national debt surpassing levels that would have been unthinkable just a generation ago. Central banks started asking uncomfortable questions. What happens to our dollar reserves if the U.S. experiences a fiscal crisis? Second, and this is crucial, we witnessed the weaponization of reserve currency status. In 2022, when Russian foreign exchange reserves were frozen as part of sanctions, it sent shockwaves through central banking communities worldwide. If the US and its allies could freeze one nation's reserves today, whose reserves might be frozen tomorrow? This wasn't theoretical anymore. It was real. And it was terrifying to monetary authorities who suddenly realized that their safe dollar reserves could be rendered worthless with a political decision in Washington. Third, we've seen the rise of multipolar geopolitics. The unipolar moment has ended, and with it, the assumption that dollar dominance is permanent or even desirable for many nations. History shows us that when faith in a reserve currency erodes, precious metals become the ultimate safe haven. It happened with the British pound after World War I. It happened with gold's surge during the 1970s inflation crisis. And it's happening again right now. Except this time, it's not retail investors driving the trend. It's the central banks themselves. So what are the experts saying about this unprecedented gold accumulation? JP Morgan's commodity research team has noted that the current pace of central bank buying represents structural rather than cyclical demand. In their analysis, this isn't a temporary response to specific economic conditions. It's a permanent reorientation of how nations think about reserve management. The World Gold Council, which surveys central banks annually, reported that the reasons for gold accumulation have shifted dramatically. Top motivations now include diversification away from dollar assets, concerns about currency weaponization, and long-term store of value in uncertain times. These aren't typical economic concerns. These are existential questions about the stability of the international monetary system itself. Goldman Sachs has raised its December 2026 gold price forecast to $5,400 per ounce, explicitly citing persistent central bank demand as a key structural driver. Their analysts note that unlike retail investors who chase momentum, central banks are price-insensitive strategic buyers who will continue accumulating regardless of short-term price movements. Union Bancaire Privée, one of Switzerland's largest private banks, forecasts year-end gold prices around $5,200 per ounce, stating that official sector demand has become the most important marginal buyer in the gold market. But perhaps the most significant expert insight comes from emerging market central bankers themselves. In anonymous surveys, many have indicated that building gold reserves is now considered a matter of monetary sovereignty and financial security. One central banker from Southeast Asia was quoted saying, "After seeing what happened to Russia's reserves, we realized that our dollars aren't really ours. Gold in our vault is truly ours." This shift in mindset from viewing gold as a legacy asset to seeing it as the only truly secure reserve asset represents a philosophical transformation with profound implications for the next decade. Now let's talk about the supply-demand dynamics that make this trend so powerful for precious metals prices. On the supply side, annual gold mining production is relatively fixed in the short to medium term. The world produces approximately 3,000 to 3,500 tons of new gold each year from mining operations. This figure grows slowly, maybe 1 to 2% annually in good years, because bringing new mines online takes 7 to 10 years and requires billions in capital investment. Recycled gold adds another 1,200 tons annually to supply, but this source is also relatively stable and tends to decrease when prices rise. People hold on to their gold rather than sell it. So total annual supply sits around 4,500 to 5,000 tons. Now here's where it gets interesting. Central banks alone are absorbing 755 tons in 2026, about 15% of total supply. Investment demand from ETFs, retail buyers, and institutional investors accounts for another significant portion. Jewelry demand, particularly from India and China, continues strong. Industrial applications consume a steady amount. When you add it all up, the market is in structural deficit, meaning demand exceeds new supply. The only way this deficit can be satisfied is through higher prices that incentivize existing holders to sell. This is Economics 101, but it's powerful. With 60 tons of central bank buying every single month, sustained, predictable, price-insensitive demand, the market must constantly find new equilibrium at higher price levels. And here's the insider insight most people miss. Central banks are accumulators, not traders. When retail investors panic sell during a 10% correction, central banks are often the buyers stepping in. They provide a price floor. They smooth volatility. They create what analysts call structural support. Think about what this means. Every month, 60 tons of gold gets pulled out of the available supply and locked in central bank vaults, where it will sit for decades, maybe forever. That gold is effectively removed from the market. Over time, this creates increasing scarcity for all other buyers, investors, jewelers, industrial users. The supply-demand mathematics here are inexorable. With mining production growth limited, central bank buying sustained, and recycling stable, the only variable that can adjust is price, and that variable only moves in one direction, UP. So where are prices headed? Let's look at the scenarios and the math behind them. Base case scenario, if central banks maintain current buying levels of approximately 750 tons annually, and if investment demand remains moderate while mining supply grows slowly, we're looking at Goldman Sachs' target of $5,400 per ounce by December 2026. That represents about an 8% gain from current levels. Not spectacular, but steady appreciation backed by fundamental demand. Bull case scenario. If geopolitical tensions escalate, if U.S. fiscal concerns intensify, or if more central banks join the aggressive buying, we could see prices push towards $6,500 per ounce by late 2026. This would represent roughly a 20-30% gain. The trigger here would be an acceleration of de-dollarization or a major currency crisis that causes flight to hard assets. Super Bull scenario. In a scenario where the dollar loses significant reserve status more rapidly than expected, or where a major financial crisis triggers simultaneous central bank and retail buying, gold could potentially surge past $7,000 per ounce. This is the tail risk scenario, but given current monetary conditions, it's not as outlandish as it might sound. Now let's talk about the ratios that matter. The gold to silver ratio currently sits around 45.1, meaning 1 ounce of gold buys 45 ounces of silver. Historically, this ratio averages closer to 60.1 or even 70.1. If we see the ratio normalize while gold rises, silver could dramatically outperform. We're talking potential 50-100% gains if silver catches up to historical norms while gold advances. The gold to S&P 500 ratio is another key metric. Currently around 0.75, meaning it takes 0.75 ounces of gold to buy 1 unit of the S&P 500, this ratio has historically peaked above 2.0 during major financial crises. If we're entering a period where hard assets outperform financial assets, which central bank behavior suggests, this ratio could double or triple, meaning gold significantly outperforms stocks. Here's the crucial math. If central banks buy 755 tons in 2026, 750 plus tons in 2027, and continue at this pace for the next decade, they will accumulate roughly 7,500 tons over that period. That's equivalent to about 2 years of global mining production being permanently locked away. The compounding scarcity effect becomes more powerful each year. Now, I need to be clear about the risks and provide a balanced perspective here because responsible investing requires understanding both the bull case and the potential challenges. Risk number 1, price volatility. While the long-term trend may be upward, gold can experience sharp corrections. We've seen 10 to 15% pullbacks even during bull markets. If you're buying at current levels, you need the emotional fortitude and time horizon to withstand potential short-term volatility. Risk number 2, opportunity cost. If stocks, real estate, or other assets significantly outperform precious metals over the coming years, you'll have opportunity cost from gold allocation. Diversification is key. Gold should be part of your portfolio, not your entire portfolio. Risk number 3, policy reversal. If U.S. fiscal policy dramatically improves, if geopolitical tensions ease significantly, or if dollar confidence is restored through sound monetary policy, the urgency behind central bank gold buying could diminish. This would reduce the structural support we've been discussing. Risk number 4, market manipulation concerns. The precious metals markets have historically been subject to manipulation allegations. While central bank buying creates fundamental support, short-term price action can still be influenced by large traders in the futures markets. Risk number 5, storage and security. Physical gold requires secure storage, which comes with costs and logistics. ETFs solve this problem, but introduce counterparty risk and may not perform identically to physical metal during extreme scenarios. That said, the fundamental case remains compelling. We're not talking about speculation or momentum trading here. We're talking about following the playbook of the world's most sophisticated monetary authorities who have access to information and analysis that far exceeds what any individual investor possesses. The balanced view is this. Gold should be a meaningful part of a diversified portfolio in the current environment, sized appropriately to your risk tolerance and time horizon. It's not about going all in. It's about intelligent allocation based on the macro trends we're observing. Here's the bottom line, and why this matters right now. We are witnessing a historic monetary transition that happens maybe once or twice per century. The dollar-dominated system that has prevailed since 1944 is evolving toward a multipolar framework, and gold is the bridge asset facilitating this transition. Central banks are accumulating at record pace despite record prices. Think about what that tells you. They're not waiting for a pullback. They're not trying to time the market. They're buying strategically because they understand that $5,000 gold is cheap compared to where prices will be in a world with 7,500 tons of additional central bank accumulation over the next decade. The window to position yourself before this trend becomes obvious to mainstream investors is closing. Once headlines start screaming gold hits 7,000 or dollar reserve status collapsing, it will be too late to get in at attractive levels. So here's what I need you to do. If you found this analysis valuable, smash that subscribe button and hit the notification bell. I'm publishing deep dive content on precious metals, economic trends, and wealth preservation strategies every single week, and you don't want to miss what's coming next. Leave a comment below telling me what percentage of your portfolio is currently in precious metals. Are you positioned for the de-dollarization trend, or are you still overexposed to dollar-denominated assets? I read every comment and I'll respond to your questions. And here's your action item. Share this video with anyone you know who cares about protecting and growing their wealth. The mainstream financial media isn't covering this story with the urgency it deserves. They're still focused on quarterly earnings and short-term market noise, while the foundations of the global monetary system are shifting beneath our feet. Your friends, your family, your colleagues, they need to understand what's happening with central bank gold buying and why it matters for everyone's financial future. Remember this, when central banks vote with their vaults, smart investors pay attention. 755 tons of gold doesn't lie. 95% consensus among central bankers doesn't lie. The de-dollarization trend is real, it's accelerating, and it's creating one of the most compelling precious metals setups we've seen in generations. The question isn't whether gold will be higher in 5 years, the structural dynamics guarantee it. The question is whether you'll look back and wish you'd positioned yourself when the trend was still in its early stages, or whether you'll actually take action. Thanks for watching. I'll see you in the next video, where we're going to dive deep into silver's explosive potential as gold's more volatile cousin, and why the gold to silver ratio could be setting up the trade of the decade. Until then, stay informed, stay strategic, and remember, in times of monetary transformation, those who understand the game early are the ones who build lasting wealth.